Welcome to our presentation for results for the half-year period ending 31st of March 23. I'm always delighted to do an equity developments presentation. I'm joined today by our CFO, Charlotte, who will deal with the numbers aspect of this presentation. There's a list on the next slide of what we'll be covering today. I'm going to talk about our service offerings and how that's changed and some operational highlights. Charlotte will take us through the financials, the regional split and the cash flow. We'll then do summary and outlook, and very, very happy to take as many questions as you wish afterwards. So from those of you that have followed the stock for a while will know that our policy over the last 3 years has been to push to grow our expert witness offering, which is called Dialis. You can see that at the top of the screen at 41%. It's a bit of a jump from the last time you would have seen these numbers. It was previously about 26%. That is partly due to the restructure of the Middle East, that we've taken out some work that was either project services or driver tret, and partly due to our continuous marketing push to increase our market share in expert work. The project services business at 19% is likely to fall a little further because that includes one remaining overseas operation, but is mainly done in the northeast of England. And driver tret is mainly claims preparation and some dispute resolution work that we do across the world. The next slide gives us a geographical split, and you can see there that the Americas, which is a business we started effectively organically from scratch about 2 years ago, is mainly expert work. It's mainly the red Dialis color. No, we've never offered project services there, so that sits at 0. That's the split. That's the model that we're looking to get through across the globe. You can see over in Asia Pacific, we've shut and moved out of project services altogether. A little bit lower percentage than we would want of expert, but then we've got some people to hire. Particularly in the UK, we want to see experts working on Asia Pacific work, part of our overall strategy of having the UK and Europe as a hub. But a very strong business for us in Asia Pacific after a number of changes we've made. Not a great start to this year, but I think they'll finish strong and be well placed for next year. Middle East still has 6%, which is the business in Oman, which we are scaling back. And 30-odd% of Dialis work is because of the number of experts in that region. There's currently only one testifying expert there, but again, more UK experts will be practicing in the Middle East over the coming years. And the split in Europe shows that we do, of course, have that northeast England-based project services business, but a much higher proportion of Dialis. And you can see Dialis expert work and driver tret work in Europe is roughly balanced. It's about 50-50, which was what our expectation was for this year. On the next slide, you can see a trend line in amongst the more spiky red, gold and teal lines. The top trend line, which is dotted, shows that we are reducing the amount over the last couple of years of our driver tret work, and the bottom dotted line shows that there is a proportionate increase in expert work as our market share. So we are focusing our marketing spend, and our directors are focused on growing higher margin work. You can also see there's a drop-off shown in project services. That's partly due to scaling back in Oman, but also project services had an absolute record year last year. And what they've returned to effectively is normal trading in line with business plans. So that drop-off is a little steeper than perhaps the true picture really is. Now, the next slide gives you, many of you know the stock and have followed it for a number of years, and I entirely get that. For those of you that don't, and there are a number of new people joining the presentation today, we operate all over the world, and this map does give you a bit of a closer impression of how widespread the geographies that we're working in are. We would normally expect to have about 1,000 live commissions at any one point across the world. So this is very much a global business, which was previously run from hubs in the Middle East, in Dubai, in Singapore as a hub for APAC. and UK and Europe. And what we're now doing is running effectively the UK and Europe as our main hub for the business, and our regions across the world making and covering their costs, but moving towards also being supported centrally rather than growing businesses across the world, which was our previous policy with my predecessors. I think the next slide takes us into an example. I think we used this one previously, but to give you, there is one large project that one of our most senior experts is working on at the moment, which is in Australia. He is based in the UK. His support team are based in Dubai, or in this particular instance, that one of them is actually based in Oman for various logistical reasons. And we also have some support in the UK as well. But what you're seeing there effectively is a large project that leverages our global reach and shows how we can operate together rather than in silos, which will increase and improve our margin over time. Now, the next slide, I think, takes us to those operational highlights I mentioned earlier that I wanted to pick up on. What we've seen this year, this half year, is a return to profit for our group, which is particularly pleasing. A lot of hard work's gone into that. We've got a Middle East business that is operating in profit in H1. We have a much closer focus on that worldwide integrated business that collaborates between offices, which is helping to drive utilisation. Our headcount for experts is at 51, which is surprisingly pleasing, because in our Middle East changes and reshuffle that we made, a few experts exited the business there. So we've managed to backfill that headcount, which I'm quite pleased about. Overall, we have a strong pipeline of inquiries. Always difficult in this business to predict what you will and won't win and what will and won't come through. But the inquiries is the basis on which that's the market you operate into, and that's currently quite strong. And we strengthened the board last year with the addition of Charlotte, and this year again we have a new chair with Sean Smith, who has brought to bear a great deal of corporate experience and is a valuable addition to our group board. The next slide gives us some numbers, which I think, Charlotte, you perhaps be kind enough to take us through.
Certainly, thanks, Mark. You'll see on the top line there, revenue has remained fairly flat. We're pleased with that, given the reduction in headcount in the Middle East and APAC restructure. So to stay stable is a good result. That gives a gross profit of 6.3 million. Admin expenses, a small increase there of 200,000. That's a blend of the Haslington office saving and other changes and savings we've made and realised to March. Some of those actually attracted an initial cost, which is a one-off. We've had a couple of other small one-off costs, some inflationary and other increases. An example of one of those would be an increase in travel, now that we can travel post-COVID, giving that 5.6 for the half year. Underlying profit, 0.7 versus 0.4 from last year. Share options, we've got a 0.2 charge there. That is a charge that comes through from the existing LTIPs. And also we've announced a few exec options in the first half, and that's the cost related to those, totaling a reported profit of 0.3. From that, we get an earnings per share of 0.6. Net cash has increased to 5.3. I'll go through the cash bridge a bit later, and utilisation has increased to 75.6. I'll now take you through the regions on the next couple of slides, starting with Europe and Americas. We have, for the first time, excluded DPS from this, as we've been asked to show that separately so that we can highlight the differences in the rates and the utilisation, etc. So Europe and Americas, for the main part of the business, revenue increased to 14.6. That's an indication of it now being the central hub, and the revenue that previously went through the Middle East and APAC coming back to this region, giving a segmental profit there of 2.5, almost a 50% increase. Headcount fallen to 139. Utilisation there still a little bit low at 68.9, but we're working on increasing that. But it's still an increase over last year. Next slide, please, Hannah. So this is driver project services. You'll see, just jumping straight to the bottom, the really high utilisation there, 96.4, which is a consequence of the type of work that we do. This is sub-consultants sitting in clients' offices 100% of their time, fully utilised. The arrows all point down, but actually they had a really record year last year. So it's not all negative. They still delivered almost £500,000 in segmental profit. And part of the reason for that reduced revenue, you can see, is a reduced headcount down to 84 in this year, just the way the work cycles have gone. Next slide, please. Middle East, reduced revenue in line with the restructure. I have actually inserted a line here for operating profit, because I felt it was important to stress that we are back to profit at an operational level in that area. We put through some very prudent provisioning for the audit, if you like, for the review, to turn it into a segmental loss of 0.1 on the interim report. But I'm hopeful that when that debt comes in, I'll be able to reverse that, hopefully by the year end. The reduced headcount there to 33 from the restructure, but they've had a good utilisation increase up to 72%. And the last region is Asia Pacific. Less affected by the restructure than Middle East was last year, but revenue is still down to 1.4 from 1.7. Still a loss, but a much smaller loss, and working really hard to get that back into profit. Much lower headcount and low utilisation, which is really a result. That's why there was a loss, because we had low utilisation for a couple of fee earners. And when it's a small office, a couple of fee earners with work that's stopped, as it had in this case, can have an impact very quickly, but they are now both working and busy. So we're hoping for a better result in H2 from Asia Pac. Next slide, please. Just a quick word on the cash bridge. We had a net cash position in September of 4.9. That has increased to 5.3 at the half year. The major movements really were the operating cash, so the 4.7, when you add back into that the amortization on the right of use assets and other amortization on the system and depreciation, that's an increase there. Leases a negative £1 million, and that is mainly the payment to surrender the lease at Haslingden that we put through as an onerous lease last year. So the charge went last year, the cash has gone this year. The cash was actually 600,000, and the other balance there is the other normal lease payments. Working capital is a positive there of 0.9. We had some very positive receipts in the H1 from Oman. 1.8 million pounds has been received there. We did have to make a payment on our forward contracts. They settled at a time they matured rather at a time when the rate on the dollar went against us, so there was a charge there that reduced that positive working capital inflow, but it was still at 0.7 overall. Tax paid minimal. You'll recognise the dividend there, 400,000 has been paid in the period, resulting, as I said, in that increased closing balance of 5.3. Next slide, please, Hannah. Back to you, Mark.
Thanks, Charlotte. So an outlook and summary, effectively, our Europe and Americas business is running in a very strong way, as it has done. Always has peaks and troughs, but is running strongly and has that critical mass that we need to ensure that that's the driving sort of beating heart of our numbers as a business. Our management across the world is focused on utilisation as a KPI. That's what we need to be driving and pushing forward on. We've got a number of cost savings that we've made, but the real benefit and effect will take effect next year. A lot of those savings are property related, and there are some costs on exit, but once we get through that into next year, we'll see a lower cost base overall. Middle East back into profit, it's a big headline for us, and we'll see that making a positive contribution in H2. The business in Asia Pacific is focused on the initiative that we have in Korea, seeing lots of work coming out of there, which is very positive. The Middle East is seeing its work come from Saudi Arabia, where there's a massive investment in giga projects going on at the moment. And whilst we have short-term revenue as very limited data, we're working on improving that. It's always been a business that's been a little bit spiky on revenue, so you have to look at the period overall. But our second half is historically stronger, although you always get a slow start with Easter, which causes us some challenges in April. So our outlook is really there's nothing exceptional in our outlook looking forward. We've reduced our cost base. Our revenue is spiky and difficult to predict, but so far so good in terms of returning back to profit, getting our cost base down. We'll benefit from that strongly in the next year, and we'll be ready to have a really decent year next year and take us on to sort of progress that we're looking to make with this business. Next slide, please, Hannah. Summarizing where we are with our strategy, Europe and Americas is established clearly as our business hub globally, and we've got a big focus on collaboration with the offices to increase utilization. We've approved an interim dividend returning a further 0.4 million to shareholders. Our half-year cash balance was very positive at 5.3 and went up in the period. Profitable trading in H1 as well, with a profit of 0.7 million against a loss last year in the period. Improving cash, focus on debt collection continuing, and our cost-saving measures continuing. So to summarize, we're focused on staff retention, utilization, cash collection, and overhead retention. And those are the things that will drive the profit in the business over the next couple of years, very much in the right direction. I think the next slide, Hannah, will take us to our questions, and presumably you'd like to chair that.
You mentioned the stronger inquiry pipeline. Is this across the board regionally and traditionally? What proportion of inquiries would you expect to win?
Whilst the inquiries come across the board throughout all of the regions, more than half the work we do in the UK is actually overseas work. So the areas in which we've said we're seeing significant business for us, particularly APAC, Korea, Middle East, KSA, and South America generally, are where the bulk of those, but certainly those bigger opportunities have come from. It could be quite misleading to give a percentage of inquiries that we always win. Clearly, we don't win all of them. If we won none of them, we'd be equally in a large amount of trouble. And of course, some inquiries come in there for 50 or 100,000 pounds worth of work. Some come in for 1 million. So if we win 30 to 40% of the inquiries that come to us, it will depend, of course, on the mix as to what the value of those was. I'm not seeing anything in our win rate that suggests that's in any way dropped off. So I don't see our conversion rate affected. It's just very difficult to give meaningful, detailed figures around that because of the range of value of commissions and the quantity of them. As I say, we have 1,000 jobs live at any one time. I probably see during the average day 7 or 8 conflict checks for potential new projects. It's quite a significant volume. What I can say is that the volume of inquiries is up and the overall average value is up. I'm not seeing any deterioration in our win rate, but it will fluctuate significantly from period to period.
Thank you. Couple of questions on the timings of Easter and bank holidays. Can you give some more colour on how these impact the business? And specifically, obviously, we think of them in terms of UK holidays, but you're a global business. So why is perhaps their impact so significant?
It's about the number of chargeable days in the month, quite simply. In a short month with some holidays in it, you don't have as many people working and billing out the chargeable hours. It's a very simple equation. What we have done in reducing our business in the Middle East means that we are still exposed, but less exposed to Ramadan and Eid than we were. By reducing the business in Asia Pacific, we're much less impacted by Chinese New Year. But equally, the focus on the UK and Europe means that Easter and Christmas holidays are always really quite challenging months for us. Generally, I think if we change the calendar so there was at least 32 days in every month, that would significantly improve the bottom line of Driver. No more royal weddings, coronations, funerals, right? That also will help.
And no weekends for the staff. Excellent.
We do include that, though, Hannah, in our budgeting profile, that the fact that, when these holidays fall due. So we were expecting a slower April. It was just slightly more slower than we were anticipating due to various reasons of projects slippage or settlement, etc.
Okay, thank you. Board guidance. Again, I've got 2 on that. There was some talk a while back that you might put out some forecasts in March. That hasn't occurred. There's always been issues around visibility within the business. This isn't something new. So does your lack of appetite to put forecasts into the market speak to some greater uncertainty that you are feeling?
No. You're probably looking for a slightly more detailed answer than that, so I'll oblige. We've been working at and looking at guidance for a little while, and because our business is spiky and you can have a very profitable month in, say, September and October, split of course by the year end, if that work comes forward, you could have a really significantly good year with August and September. If it gets pushed back, you can have a poor year, but a fantastic start to the next year. So our reporting dates being fixed, but our peaks in workload moving, make that a difficult thing to do. And one of the things certainly our larger corporate holders have all made clear is that whilst they'd like to see some guidance come from us, they'd like us to get it right. And they like it to be something that has some clarity around it, that explains these various issues. And so we're not yet in a place where we feel we've done enough work to get that right. Work is ongoing on it. Our new chair has a wealth of corporate experience, which is very helpful on this topic, and it's one of the things that's at the top of the list for the board to look at. But we have all concluded, and I think probably most people would agree with us, that if you're going to give some guidance, it needs to be right, because the implications of getting it wrong would be significant. So we're putting a lot of effort into that. I'm sure you'll be hearing from us quite soon on that. Okay, thank you. That is helpful. What do you expect to do with the net cash? Would it be the correct assumption that you do not currently have a working capital facility with the UK, and why is this?
It is right. We don't currently have a working capital facility. We had a rolling cash forwarding
rolling credit facility, wasn't it?
Rolling credit, gosh, I forgot what RCF stood for. Rolling credit facility that we actually cancelled earlier this year. It wasn't the right product for us and was quite costly, so we've cancelled that. We are exploring a more vanilla type working capital arrangement, but we probably need around 5 million as a working capital float. We tend to allow the overseas offices to all hold 100,000, and so there's 1 million spread across the world straight away. And then of the perfect storm of a quarter where you have a rent quarter and a VAT quarter on top of the salaries, and the sub-consultant payments can total about £5 million. So over and above that, I think we'd certainly be open to looking at a further share buyback, Mark. We've certainly discussed it as a board. I think the thing that's the important takeaway from this is that Driver Group is a business that operates in the black with cash and isn't borrowing money. We have no borrowings. That's a really important, solid fact about us. We will at some point over the next few months get the right banking arrangements in place that allow a safety net that would give us the opportunity to be more adventurous with cash. But when we meet as a board, things like buybacks, for example, are always on the agenda to look at. And we have, I think last year we returned about 1.3 million to shareholders. And that was in a year when we had some significant challenges as a business. And this year we're back in the black and profit generative. So I think you can take all that as high levels of cash collection and a return to profitability as some really, really positive signs for this business.
Thank you. Can you give details of the profile of your receivables, including any overdue by more than 6 months?
Yes, I can. 70% of our debt is due within 3 months. It's really very, very current. And in the overseas, older than that is generally overseas. We're down to a much smaller figure than we have historically been out there, and we're also expecting some successes between now and the close of the financial year. But it's really quite a young debtor book. We have a perfectly adequate and thoroughly reviewed and audited provision on the ECL, and we're hopeful to make further inroads into that over the coming period.
I think it's fair to say our Middle East collections, which have been a challenge in the past, are many millions better than they were previously. If you look 2 or 3 years ago where we were with aged debt in the Middle East, it was quite significant, and we've brought that down by well over half. It's a massively improved picture.
That's extremely helpful. On to utilisation. You've obviously seen an improved picture on this subject during H1 23. How much further can you take it?
We think we can get utilisation ultimately into something that starts with an 8, and for the avoidance of doubt has 2 digits. And we think that that will make a very significant difference to the bottom line in this business. These things aren't done overnight. They require a degree of culture change that we're working on in the business. We have a much better Middle East management team now that's more integrated. And previously, and I took over obviously during the pandemic, but prior to that, it was much more of a siloed operation across the world. So you'd have some places really busy and some places less so. What we're trying to do now is embed a culture where excess work is shared freely across the globe. It's not a 5-minute thing to do. It's a project. We've made a really good start on it. And that's one of the things that we think will help drive utilisation up. But as I say, the target is to have it start with an 8.
Thank you. And how does the new ERP software benefit this utilisation and visibility?
No, please.
Yeah, visibility mainly, and that we now have much more accurate time recording on a weekly basis, and so we're able to keep an eye on that much more closely. Every week we look at every resource throughout the group and what they're working on and where the gaps are and can we plug those in. What the system won't do is help us with the forward looking of utilisation. Because we don't know what projects are coming, so we've still got that issue, but it's certainly improved massively compared to what we had before.
Can you give a little more detail on the significant cost savings you're expecting later this year?
I can, yes. We've set ourselves an internal target. To September 22, we had secured 38% of those. It was mainly the Haslingden office that we put through as an onerous lease that I mentioned earlier, and a few other small savings. This financial year, there'll be another 22% up to September. Most of those are actually in Q4, so we won't feel much of the benefit of them during this financial year, but they'll come through for next year. And then we've got 40% coming through next year, which again is mainly property related and a few things to do with some of the closures in the Middle East. So all identified for our initial target, although rest assured we're not going to stop there. We're going to keep reviewing costs wherever we can and reducing them, but most of them will come through in next financial year.
And there's an adjunct to that. How's the new Seoul office, and is that still a cost centre?
Well, the new Seoul office is going very well. We launched that back in, I think it was back in March. I was in.
End of March, yeah.
It is effectively, it's a very small office where we have one person permanently on the ground who is working for a client in Seoul, but able to pick up on business development for us. We also have a Korean national working for us in Singapore who spends a lot of time using contacts in Seoul to pick up work. And we've also recently hired a chap who is Scottish, but a fluent Korean speaker. So I'm not sure what Korean sounds like with a Scottish accent because I don't speak Korean, but I'm sure it's interesting. So for us, it's all about winning work. And we came away from 4 days in Korea of marketing and a successful office launch with $700,000 worth of work as an order straight away. So it's one of the most positive things we've started. It's going well. It is a cost center that we can measure the performance of separately. For me, it's very much part of Singapore in terms of its management and staff moving back and forth from there, have the skills to win the work. But actually, it's one of the best things we've done over the last couple of years. It has taken a couple of years to get going because of the challenges of visas, setting up legal entities and banking and that kind of stuff. There's very limited competition in Seoul itself due to those hurdles. And also we see a lot of major Korean contractors working in Saudi Arabia on these mega projects. So for us, that's about sort of joining the world up. It's very low cost is the answer, and it's so far, I'm trying to find some wood to touch here. There's a pencil. Very working very well.
Fantastic. Acquisitions. If there are aspirations to do any, what form will they likely take? Will they be geographical in their reach, or is it about going into new areas?
Well, because for the first thing I would say is don't expect a major acquisition of several hundred people and an enormous competitor to double the size of Driver Group, because that's absolutely not on the agenda. What we are in the business of doing is looking at the acquisition of talent. So for us, that might involve small businesses, maybe 6, 10, perhaps at the most 20 people. And it might be geographical in that we could do with some extra headcount in the US, because the hiring of people there starting from scratch is uphill and will take a while. Equally, we are also interested in things that are ancillary to what we do. So forensic accounting, materials testing, anything that's of a forensic expert nature that links to building and construction, things that do with welding and testing of pipe work, those kind of things that we currently sublet out. We're interested in all of those things. But as I say, it won't be an enormously impressive, £10 million deal here. It'll be nice bolt-ons that are low risk and manageable and are a value add from day one.
Thank you. A few more have just come in. If the company needs 5 million cash as a buffer and receivables cash collection is expected to be very good in H2, is now not the time for share buybacks? You alluded to this, didn't you, Charlotte?
Absolutely. It's very high on our agenda.
Yeah, thank you. What does it cost to acquire teams? This is a lead on from your last point, Mark. Typically, and does this have implications for the retention of staff internally?
The cost varies widely depending on the geography and the level of experience within those teams. Acquisitions like that are in the mid-hundreds to a couple of million, depending on at the highest end. So not in any way some kind of enormously exceptional sum of money for us, bearing in mind the value that would add. Staff internally would see the right acquisition as a good news story and would benefit the business overall and thereby benefit them. So we're quite experienced at managing the addition of new staff coming into the business, and it would be no different a policy than that.
Well, that is it for our questions, unless there's any late submissions, which just leaves it to me to thank you both for your time this morning, and to our audience for their extremely engaging questions. And we look forward to an update in 6 months' time.
Yeah, absolutely. And we'd also like to say thank you to all the participants that have joined today. We're very happy to spend some time talking about Driver Group. It's something that we put a lot of energy and passion into.
Thank you both.